and thank you for staying so late. You're very dedicated, so we really appreciate it. How many of you are still awake? Nice. Amazing. How many of you are founders of companies, of startups? Few. Any investors? I see one investor. Can you hear me? Yeah. So I'm very excited for this panel. I'm going to give each person a minute or two to introduce themselves, tell you a bit about their background, and then we can start talking about exits, everyone's favorite topic. Do you all have mics? Let's start with Ayman.
Sure. Hi, everyone. I'm glad to be here with you. I echo Sara that it's pretty late, so thank you for your commitment. I'm Ayman Tanbouly. I'm the co-founder and chief executive officer of Exits Mena, the Middle East's first investment banking platform that focuses on tech startups and SMEs. I come from a pure investment banking and financial advisory background, and I have around 11 years of experience in that field. Thank you.
My name is Kiosar. I am the executive director at August Hill. We're a boutique advisory and VC firm based in Chicago with a presence in Latin America. I am here to explore opportunities in the region. I'm bullish on this region. I've been pestering the managing partners at my firm to start exploring it, and that's what we're doing now. Prior to this, I spent 10 years helping build tech companies, early stage Series A, all the way to a company that exited with a $8 billion IPO. And I'm also involved in scaling innovation ecosystems. And first time in Egypt. So far, it's been great. So thank you.
My name is Loay El-Shawarby. I'm an attorney at law. I'm just a lawyer, helping companies left, right, and center, small, medium, and large. And over the last 14 years, I've also been engaged in angel investing. So I've invested in some 20, 25 startups up till now. One of them is actually Techni Summit, so hopefully that was a good one. I also co-founded with Sara the Alex Angels and the Mediterranean Angels Networks. And I'm happy to be with you here tonight, and hopefully you can exchange ideas about exits. Much prize if you want to look the exit before you hopefully invest. Okay, thank you so much. Pleased to be here.
Hi everyone, my name is Mareme. I lead 500 Africa strategy. I see that they got the title wrong there, but so my focus is on Africa specifically and the work that we are doing to make sure that we can empower entrepreneurs in the region. I've been now at 500 for almost 3 years, and I focus on really both Sub-Saharan Africa but also North Africa, so that includes Egypt. And Egypt is a location where we've had now a few great investments. We've invested in companies like Maxab, and so we're very excited to be here.
Amazing. Thank you so much for coming and for staying up so late.
Yeah, thank you for everybody for staying up.
How about we start off, if each one of you can talk about different exit strategies that you've experienced or that you've seen. We'll start with in the middle with Loay, maybe, if you want to talk about one of the exit strategies that you've seen.
Well, it's a big topic, so I'm not so sure how people approach it, but I think every investor might approach exits, according to their own appetite, the level of funding and the stage of investment that they are in, and also the comfort that they have with the market. So I think, the interesting is who's exiting. Is it the investor who's exiting, or is it the company that is exiting? Because at the end of the day, you put your money into a company that gets financed over multiply in stages until it matures, and hopefully there's a big, exit for everyone. But some people exit before others. So if you're one of those, you might be minding your own business before you mind, the whole pool. And that's such is the nature of tech investments, as they keep evolving, and the actors or the supporters in the company change. So this is one way to look at it. So for us, sometimes as angels, we come very early in the business. So sometimes we try to get actually partial exit before, while the company is still running, and then hopefully we also wait with the company for the upside, for the big upside at some point. So sometimes, at least the way we look at it, for myself and for networks that I'm involved with is that sometimes we want to get some partial exit and then a full exit. But that's just about, people would have it differently, I would think. Okay, thank you.
And how about IPOs? Like, what do you guys see as the scene right now versus 10 years ago? Like, number of companies. Like, we talked about it earlier. If you want to kick us off with that.
So I think something to also remind, because we have so many founders in the audience today, is when we're talking about an exit, because also we should be able to define what that means for you guys. An exit can be two things. It's either, especially in our case, in our relationship with the founder, we consider an exit to be a liquidation event. So it is an event in which there is a liquidation of our shares or liquidation of other stakeholders' shares, but it has to involve some sort of that. And then when it comes to the company itself, an exit is basically any event that happens to the company that changes the structure of the current shareholders to a different structure. And that could also be in the case of a company failing, a winding down, or a write-off if the company or a bankruptcy, which is also an exit, but it's not an exit in the way that we think about it. And what we're seeing right now, and if you've been looking at, capital markets, if you're savvy in terms of what's happening in the public market, we're seeing that now tech companies in particular are taking a lot longer to actually IPO. And that's for a few reasons. The first main one, which is an obvious one, is the capital market conditions are different that they used to be. And so companies are afraid to actually IPO in the case that they won't be able to keep the strike price that they exit at. So that's one. A second component that we're also seeing, and we've seen this over time, is that with the growth and development of later stage investors, so now you actually have investors who are investing pre-IPO, and what that means is that they actually take a big chunk of financing that in the past you could only have through an IPO. And so the different liquidation events that are happening, especially from a founder perspective or for an investor perspective, the incentives can be aligned or misaligned depending on what's happening in the company, but also specifically related to IPOs. If you're an early stage investor or if you're a later growth stage investor, your incentive and your rationale and reasoning behind an IPO of a company may be completely different to what they used to be 10 to 15 years ago. So as a founder, if you're starting to build your company now and for some reason you have in your mind that IPO could be a path that you would want, and those could be reasons that are very individual to you, I would really urge you to start thinking about how do you create the path towards IPO, because that path is completely different from what it used to be 10 years ago.
Thank you. And also, Q, since you were an operator before, and now you're more on the investor side, where do you sort of see the balance given everything that she shared with us now?
I didn't catch the last part, sorry.
What's the balance like that from an exit perspective if you're a founder versus if you're an investor?
Yeah, I mean, so I'll start with the operating side, right? Because I think, from a founder perspective or an entrepreneur, part of it is understanding exactly what is the end strategy for you. Is it to keep this company going and build a longer term business? You're going to have to find ways to repay the investment with a multiple for the investors, and there's multiple ways to do that. Or to your point, if you're thinking about IPO, I think it's important to consider the various financing rounds, because like, why do you raise money? Like, when I talk to founders, it's like understanding the milestones that it needs to take for you to get to your exit, right? So it's like, how do you get that financing so that you can connect the resources you need to get the outcomes that you want? It's not raising capital just for the sake of raising capital, because during this bull market, I think a lot of that was happening where founders who didn't necessarily need capital was raising capital, and that created a lot of, at least in my opinion, a lot of bad behaviors from both the investors and founders. So, and then on the, would say investor side, it's thinking about a long-term strategy with the founder so that you can put together something that aligns for both of you long-term, right? Because when you get in a relationship, it's a long-term relationship, right? You're talking about, if on the life of a fund it's 10 years and you're looking, at least in the US market, it's an 8 to 10 year exit. So you have to be able to build that in and understand what the likelihood of a successful exit for this specific company is. And kind of my opinion around how companies should set themselves up for an exit is like, I never really understood the part about growth at all costs. I think that just encourages bad behavior, but that was happening quite a bit during this bull market. I think if you're looking to build a startup or any company, really think about how quickly can we get to profitability and what does that path look like using the least amount of resources so that from a founder perspective you can retain as much of the company as possible in a case of a liquidation, and obviously control of the company as well.
And Ayman, from M&A perspective, like, I haven't seen a lot of acquisitions in the region, but from your perspective, like, what happens before an acquisition? Why haven't we had that many? And what happens after an M&A happens?
Well, I think I echo Mareme here in what she said, that an IPO might not be as easy as it used to be, especially in the prevailing market conditions. So I think M&A is more or less a more relevant exit solution right now. Why it's not been happening frequently? Because when you're developing your exit strategy, which is like the topic of why we're talking now, what we're talking about now, is mainly that you're not, as a startup, relevant enough to the strategic investor that is going to either merge with you or acquire. When it comes to relevance, this is a corporate decision. When it comes to merger, not an investment decision. For a corporate position, or for a corporate decision, it has to fit 4 criteria for the investor. Does it entail synergies? Will you be able to group business activities? Will you be able to unify certain costs? Will you be able to better manage certain operations in a smoother and a more efficient manner? Second, being horizontal integration. Are you relevant to a startup or a business, be it conventional business, be it a tech business that operates in your industry or an adjacent industry that seeks to increase its market share, that seeks to expand its business operation, that seeks to sort of like reach momentary growth through acquisition rather than building business units on their own, which takes longer. The third consideration is vertical integration. If you are, from an investor perspective, someone who lies or like fits within their supply chain, are you a service provider? Are you a supplier? Are you a distributor? And the fourth thing is diversification, which pertains to a startup or a business or a conventional corporation seeking to diversify its portfolio. If you fit one or more of these 4 criteria, you are relevant from the perspective of a strategic acquisition for M&A. Think of what Facebook did with WhatsApp and WhatsApp and Instagram. Now think of how centralized the operation is at the Meta level. That's synergies. Think of what Netflix has been doing when they have been acquiring studios. That's vertical integration. Think of what has been happening on the level of Uber and Careem. That's horizontal integration. Think of what Aramco is doing right now. They're investing in drones, they're investing in tech, they're investing in all sorts of other non-core businesses other than oil. That's diversification. So if you're not building a business that's relevant from a strategic investment perspective for M&A, then you cannot really seek M&A as a potential exit.
And actually, as a double down to what you just said, I think in addition of being able to be relevant, you have to be able to get to the level where you can be structured to be acquired.
Governance is a crucial thing.
Governance, structure, accounting are key extremely key for M&A, even more so than any other type of exit. And what we're seeing with founders right now in startups is that even when they're high growth, the numbers are very promising, there's a lot of raised capital, there's no accounting, there's no formal auditing, there are no C-suite executives on any of their high-level operations. And so from a corporate perspective, even if they find your business attractive, and even if they find that there is relevance, if they acquire you in that state, you become a liability because there is just no record bookkeeping to show that the numbers are true, to show that you've done all of your transactions properly, and to show that there is no possible liabilities that come in. So also from a corporate perspective, I think we really need to think about, especially for startups who could think of M&A as a potential exit, you have to make sure that by the time you get there, you're structured in a way that makes it possible.
Exactly, and I just want to add one thing here is that most of these deals fail not for the lack of opportunity, but for the inability to conduct proper DD. And I think Loay can shed more light on this. I mean, most of the deals, they don't pass DD for simple reasons that's lack of documentation, lack of ability to prove a certain cost, lack of being able to source dedicated advisors that can guide you through the process. These are the things that cause M&As to fail, not the lack of opportunity. So I echo on that.
Loay, can you expand on that?
Yeah, exactly. I mean, it's a lot of, many times when entrepreneurs get excited, building their companies and they think that they can do all the genius work with no record keeping, as was being said. So, and then comes a moment of truth, when anyone's talking to you, whether actually for investment or for exit, for acquisition or something like this, if or a divestment of part of the business, then it becomes difficult. They have nothing to interrogate. They have nothing to look into. That's either they would do guessing. If the purchaser is a big company listed on a stock exchange, then it becomes a liability right there. Or they take so much time to help you to put things into perspective again, and that takes time and takes effort. And unless you are really something that they don't want to miss, no one is going to touch you. I mean, they'll just leave you down, to continue your genius, doing your own thing, and that's it. And also, I think that this takes. So I mean, good to have governance in place, and good also to stick to it. To just not to only have it once and say I have it when I need it. No, actually, just you persist on it, because this is how you interact with anyone. Actually, if you want even to go to a bank later to get commercial loans, you would still need them. So
exactly.
I mean, bookkeeping is a good habit. Genius is good, but a little bit less might get you a long way. So anyway.
Can you give us an anecdote of an experience that went bad and how you handled it?
Actually, so many companies, I mean, without names, but I mean, so many companies, they get excited. Big companies want to look at them, so they promise them the sky and the moon. We have the best software. They look at the software, they find that it's not registered, or that it is passed out with so many people. Everyone has a piece of it, thinking that they own this piece, depending on who has worked on the software in a given day. And if someone is going to have a patent, for instance, maybe they have gone around talking about it already. When it's already disclosed, there's nothing to patent, or you wouldn't get a patent grant. But so there's a lot of difference between perception and reality. Because you continue to feel, if I'm being a good man, if I'm being, really smart people. And this is where, a lot of the big companies, they just, don't want to, they get excited a bit and then they just leave it. And this, I've seen this, in so many places. It's not worth it.
I mean, even a small example to echo what was just said is I've seen companies that have gone through an M&A or trying to go through an M&A process, and they don't even have IP agreements in place with their current and former employees. So if the IP actually doesn't belong to the company, because you've never signed an IP agreement between even your employees, your current employees, your former employees, then how can you prove that anything that anybody has worked on during the time that they were at the company actually belongs to the company? Not even to you as an individual, but belongs to the company. And again, from a corporate perspective, these becomes liabilities, because then someone else can come in and actually say, oh, this corporate is doing thing, they actually stole my idea, because there is no proof. And that's not even as complicated as a patent. That's just signing an IP agreement with all of your employees. But I've seen companies, startups, that don't have IP. And actually, we've said that there are founders here. How many of you have IP agreements in your startup? Two? There are only two founders here that have IP agreements. Everyone else does not have IP agreements. And just that, a small example, could be a big liability for you as a founder, for your employees, and if you want to get acquired. Another example is also, I've looked at a company going through also, again, the beginning of an M&A process, being asked their financial and their status of transactions, and they had spreadsheets. That's it. Just spreadsheet, manually computed spreadsheet. There is no audit that has been done to show that these spreadsheets are actually the valid, correct numbers. There are no records, bank records, transfer records, receipts, vendor receipts, no receipts. Companies that are spending money, company money that has been fundraised, so investor money being spent with no receipt to actually prove and show that if they say, oh, I used an Uber from here to the hotel because I was going at a work conference, there is no receipt to show these transactions. And these are small examples, and we've seen many, many, many more of these are large companies. They've raised hundreds of millions of dollars, about to be acquired, because obviously these didn't go through, about to be, and did not have any of these basic information. So these are, and also I would strongly say that these are the type of habits that you want to make sure you're implementing at the earlier stage. It's so much harder to start doing this once you've been working 5 years differently. If you want to wait until you're at the series C or D to start getting structured, it will be extremely hard for you to implement this on yourself and on your employees, because certain habits, once you have them, they're just really difficult to change.
Yeah, I just want to summarize this into kind of like stating the basic misperception that founders have. You're not selling a solution or an application or a website. You're selling a business. You're selling a company. This entails governance. It entails self-sufficiency. It entails that you look at the entire P&L rather than just focusing on your top line. It entails having proper documentation. It entails having very accurate and realistic growth projections. It entails that you are merging into a business not as a department or a tech team. You're merging into a business as a business company, as a separate arm. This facilitates post-acquisition integration. This preserves your valuation. This increases your likelihood of landing on several M&A deals, not just one that you've been chasing for quite some time. So just to kind of like summarize like the misperception that's got out there.
And actually to complement that, you know, when big corporates buy, they always have the, you know, they consider the options, buy versus build, you know. So they can also build it, you know, if it will take more months or a year or two. So when they buy you, maybe they want to be quicker to the market, but they don't want to to just go to lawsuits or to try. You know, so it's just buy versus build. They would say, okay, build it or something like that. So maybe you bought yourself more competition in the market.
A question for all of you: like, how would you advise for a founder to find an acquirer or to shop around for acquirers? Is it on the investor to help the founder? Is it on the founder? Would the lawyers be the ones helping? Like, what do you guys think?
Come to Exits Mena.
Free advertising.
I would say, you know, lean on your investors, but also build your network, right? Because, you know, whether it's going through an event or going to, like, I don't know, events, conferences, and just connecting with people who are in the space, so you have a better understanding of actually what the market looks like. And, you know, because sometimes you don't even know that you're looking to get acquired or an exit until you have to. And then the network that you built will come in handy, because it's, you know, it's not always about like, well, I guess what I'm trying to say is like sometimes you're kind of forced into the action, and you need a good network to tap into And like I said, it could be other founders, it could be your investors, other corporations, right? So especially right now, what we're seeing on our side with August Hill is, we're getting a lot of inquiries from startups to assist them, both startups and also established companies who's, they have capital to spend to help them with M&A activities, because right now, there are good companies that are available on discount. I mean, that's the reality of the market that we're operating in now.
Yeah.
You want to go? I was going to say, if you ever get lucky enough to be in a position where you're actually able to consider an acquisition, I would strongly suggest to work with professionals. And this is the only time in the venture cycle where it is actually very important to work with M&A experts and not to simply rely on the knowledge and goodwill of yourself and your investors. Because in addition of making sure that, because by the way, M&A is quite a complex, heavy, very, very, very heavy process where you need to have people who actually know exactly what they're doing and who can take some of that heavy lift off. So even aside from that point, you have a fiduciary duty to your board to show that if you've made an M&A decision, you've made it with the best possible buyer for the company. And so you will actually have to prove and show that you have been able to basically shop around and look at all the possible acquirers, and you've chosen the best, and you've chosen the best based on data. We also have to remember that M&A is not necessarily a question of, oh, I really like, for example, I've been working with Amazon for 4 or 5 years as a provider. They really like me. I love the management. So I want to sell my company to them. It doesn't work like that. And even if you, as a founder, personally, you really, really wanted to have that deal go through, you actually have to be able to show to the board that this was a responsible decision made, taking into consideration all fiduciary duty. So you would have actually to look at all the other potential buyers outside of Amazon or whoever you want to actually realize what is the best deal for the company. And for that reason, it's really important. I always advise founders to work with a professional. Work with a professional M&A expert, because not only they have the expertise of the transaction itself and supporting you in the transaction, but usually if they're an M&A expert in your sector, then they have relationship with all potential buyers, and they can be the one to actually help you vouch for how solid and justifiable of a deal you have.
Okay, thank you. I want to add something as well. Be relevant. Develop your business to be relevant, because this is, and get some market share, of course, because that's, the best thing that would get people interested in you. Be present, of course, to speak about your business and also to network enough. And over the years, I've seen people who've got acquisition opportunities. They rejected because they thought, that they are the next unicorn. So statistics in the US, at least a few years back, I didn't get the updated one, is that typically 80% would fail of companies. The 20% that do not fail end up being split into 32, 68%. 68% get, sold into a strategic sale, and this is the US, maybe 4 or 5 years ago, so not so long ago. And the deals went for $10 to $30 million, not the 1 billion. This is the US, and this is 10 to 30 billion, this is statistics, okay? And then the remaining 32% went into IPOs above $100 million, okay? So just, don't really get hooked on the thing that you will be the unicorn, that, don't kill yourself for it, okay? If you can be a unicorn, and sometimes it speaks for itself if you will be one. But, take deals as they come, and remember, either you build the business to become rich or king, so just hopefully get rich before you can become king. Yeah.
What are some negotiation tips that you have for founders that are either being acquired or consolidating or exiting, basically? Ayman, you know.
Well, I think the most important thing, aside from valuation, from business plan, is how will it look like post-acquisition. Most of founders think that they're gonna cash out, go spend their monies in the Bahamas. This is not the case. You're gonna have to stick around. You're gonna have to ensure that there is a proper handover, that there is a fulfillment of the business plan that you've promised, that is based on which the valuation has been calculated. You're gonna ensure that the team is promptly and diligently reassigned. You're gonna have to stick around for 1 or 2 years. You're gonna stick around with a minority, so you're gonna have to ensure that you have the proper safeguards to be able to divest the remaining amount after fulfilling the objectives of the integration and handover, be it a call option or put option or some sort of liquidation. But you need to be certain that you're not leaving completely. This might be even an acqui-hire and you're not leaving altogether. You need to understand that cashing out is not, or like the deal consideration might not always be in cash. Actually, there is a very prominent operating model or a structure now that entails a majority of a share swap and a minority of cash to get out mainly financial investors. So you're going to have to stick around with that. You're going to have to accept that you're going to be conducting your own valuation of the acquirer to assess the shares that you're getting in exchange for your company. So to cut long story short, you need to understand the entire M&A process. You need to be able to evaluate your options, and you need to be able to assess or kind of like be accurate in assessing the value of your business and the commitments that you put forth when you present a business plan that is getting valued.
Here, did you have any negotiation tips for founders?
Not really, to be honest, because like the company, the first tech company I was at, we IPO'd, so it wasn't a merger and acquisition. I don't have experience with that. What I can talk about from the IPO perspective is it changes your company fundamentally. It took us, I think, 18 months from the time we started talking about it to the time we actually went public. And during that time, I mean, the level of due diligence, the amount of number of banks, investment banks that we spoke with, it's just a marathon, and you have to be prepared for that, right? And it's not, and I would say the other thing is like you have to be prepared to be surprised, if that makes sense at all, because they can ask for certain things that you hadn't even thought of. And then post IPO, I mean, our company fundamentally changed. Now we're a public company. The reporting was different. This is in the U.S., so like there's the SEC reporting on a quarterly basis, providing audits, and kind of going back to part of the conversation earlier where I think you asked about something bad that happened. So this company, when we IPO'd, it was at an $8 billion valuation. Like it was the largest fintech in the world at the time. 6 months after we IPO'd, there was an audit, and they found some irregularities when we were still very early stage company. And the end result of that was the CEO ended up leaving the company, and the stock price cratered by like 70%. And that was extremely painful for everyone who'd put in all that work to get to IPO stage. And it took a few years for the company to rebound. So from a experiential perspective, it's like if you're considering IPO, and I know that's only really for certain markets, make sure that you do your homework as much as possible. Be prepared because it's a marathon, and then also be prepared for post IPO, because like I said, it fundamentally changes the company, the way you operate. I would even say to a certain extent the culture of the company, and that was a big adjustment, because one of those impacts was we actually had a lot of people leave post IPO because in their words we became more corporate. So yeah.
Before I ask the last question, I want to see if anyone in the audience has any questions for the panelists. Or is everyone ready to exit? Everyone's ready. Oh, there.
I have a startup, so actually someone told me you need to have an exit strategy. But I imagine that, so I don't have any experience regarding the exiting itself, but why I need exit strategy? Because if I generate revenue, actually right now I generate revenue, so after 1 year I will knock the door of every or corporate. So I will tell them I need to sell my company to you or whatever. So actually I think he will say like, oh, you need to get rid of your startup, you are a loser, or you need to exit because maybe you are actually generate a revenue, why you need to exit. So how can this process, why do I need to have an exit strategy? Actually, what is an exit strategy if I need to do that right now while I am fundraise, while I am actually I generate this revenue? So I need to do this at IPO level or whatever. Yeah.
Well, I send you back the question. So, if you, because you mentioned earlier, if you're starting to make revenue, let's say, very luckily, very quickly, and you are a healthy company in terms of unit economics, right? Why would you need to exit your company at some point? Is that the question?
Yes.
Okay. Well, if you ever want investors, so if you're ever hoping money to come in, it has to come out.
Great.
Simple.
Yes.
If you don't want anything to come in, you can do whatever you want. You will never, no one will ever ask you because you will have nobody to answer to other than yourself. So you could keep this company's level of growth and development to the extent that you judge is adaptable. But if you ever want outside money to come in, whether it be from investors, whether it be from family and friends, whether it be from individuals, that money has to come out. Now, does that money have to come out in a way that involves you as a company as an exit? Or does that money have to come out in the sense that the investor has to exit? Let's say he could sell his share to someone else, or he could share those shares back to you, which is what we actually called cashback. So if you ever intend to fundraise money and you have outside capital coming in, unless you are willing to at some point cash that outside capital yourself, so like buy it back yourself from the people who bought it with their return and their multiple, you need to have an exit strategy. Because also from an investor perspective, and that also comes down to the fact that founders also need to understand how investors work. Investors are also managing other people's money, who they have asked to give them that money. They're putting that money into you, and they have a timeline. They also have a timeline of a life lane, we call it. So usually, most funds will have a life duration of between 10 to 13 years. And so during that time, at some point, they need to be able to exit their proceeds. And most of the time, they want to do so in a manner that is also beneficial to the company. So they want you to go public, or they want you to go through an M&A, but they can also try to sell their shares to secondary markets. And so you have to think about that, or you at least have to show that you're sensitive to also the situation of your investors if you want them to come in, because you also have to understand that they have fiduciary duty to their LPs, and they are also in a position where they have to also explain to their LPs what is going to be the exit path for them. So when are they getting their money back, and how are they getting that money back? I don't know if you guys want to add anything.
I just want to add one thing. I think it all boils down as well to your own corporate strategy, not exit strategy. The pace at which you want to grow, the market you operate in, competition. How would you defeat competition? You would want to spend more. How would you get that money if you're growing at a modest rate? You would want to seek external financing. If you cannot source this external financing through bank debts, you're going to have to source financing from investors. And investors, as Mareme said, would want to exit. So if this is not your own exit strategy, you're going to have to think of the exit strategy of your investors. That's it.
Don't have a mic anymore, but I think you can all hear me. First of all, thank you all for joining us tonight, and thank you all for staying so late. One thing to take away is to just have an exit strategy from day one when you're building your company. Have it be, your exit is to IPO, to retain the money, to be acquired or to acquire. Just keep it on from day one, and you have all these great panelists to ask questions to later after. Maybe not right now because they want to go home, but you can ask them for their contacts if you want to ask more questions. And right now the exit strategy is to exit the museum. Thank you so much.
Thank you.
You have another panel? No, there's another panel. There's a closing. There's a closing party, or yeah. Thank you.
So long, yeah.